Hello folks, this is Peter Maris from the Resource Financial Group. I hope you're well and getting ready for a beautiful spring. Hopefully it will arrive soon. Today, I'd like to address your cash reserves. So what are cash reserves? Well, in layperson's terms, cash reserves is the money in the bank. All of us have some money in the bank as our cash reserves. Cash reserves are liquid accounts, such as savings or money market accounts, used for emergencies and opportunities. This is an important topic because interest rates have been going up considerably over the last couple of years on these accounts. So I want you to know the details for maximizing the return on your cash reserves. Folks, first and foremost, cash reserves should not be confused with the funds in your investment portfolio. Apples and oranges. Your growth-oriented investment portfolio's rate of return should far exceed the interest rate on your cash reserves over time. Now the rates are higher, some people confuse better short-term rates with the returns on your investment portfolio. Again, apples and oranges. Now, the amount of money you keep in your cash reserve is a very personal thing. Some people want a lot of money in the bank for a rainy day, and some people feel that having a large cash balance is not prudent. Tell you a secret, there is no correct answer. It's whatever makes you feel comfortable. In our client's financial planning, the most crucial factor we consider is that the client is comfortable with the approach and recommendations we use. The same holds true with your cash reserves. So, as I mentioned, interest rates on cash reserve accounts like savings and money market accounts has risen significantly over the last 18 months and is now paying a much more respectable interest rate than in recent years. However, many banks and financial institutions have not followed suit and have not raised interest rates on their money market and savings accounts. They're still paying us, in some cases, 0.1% on cash accounts when the prevailing market rates are well over 3%. Again, 0.1% when the marketplace is now yielding over 3%. A client of ours recently mentioned to me that they had about $300,000 in a high-yielding money market account, and when they peeled back the onion, they realized it was only being paid 0.1%. It's 0.1% on $300,000. That's about $300 in interest per year when they could have earned $9,000, a potential loss of about $8,700 per year on a money market account. Now, I don't know about you folks, but I'll never sneeze at a loss of $8,700 for any of my clients, especially on something as simple as a money market account. So you have a choice. You can be passive and allow the banks to potentially take advantage of the situation and pay you an ultra-low rate, or you can get proactive, do your homework, and get a high interest rate on your liquid money. Here's a few suggestions on how to go about doing that. The law of least change tells us that to simply ask your bank to raise the rate on your savings or money market accounts. That way, you don't have to fill out a new application at a different institution. You'll be able to stay with what you're used to. Simple, right? While the big banks being, big banks, you may be unable to get much traction with them. Smaller neighborhood banks are generally more accommodating, so if you happen to bank there, you have a better chance of having your interest rate increased. Now, an excellent alternative to banks is establishing an online savings account that will pay you a high interest rate, is FDIC insured, and allows for no-fee transfers between online accounts and your bank checking account. Now, I've had several of these accounts over the years and find them to be very efficient. Though there are myriad options in this space, a couple high-yielding savings programs that I like include the American Express Personal Savings Account and the Ally Savings Plan. Now, you can go to the American Express website or the Ally website to find out more about these programs, or feel free to give me a call at the office. We can talk more about your needs regarding your cash reserves. Again, each option offers a high current interest rate, FDIC insurance, and no-fee transfers between these accounts and your bank checking account. So you can store most of your funds in these accounts and transfer them to your bank checking account as you need them. For example, when it's time to pay your real estate taxes, you can transfer the funds from one of these high-yielding accounts to your bank checking account. These transfers take about 1 to 2 days to execute. After the funds transfer, you can then write a check for your real estate taxes from your bank checking account as usual. Sure, it entails an extra step, but to increase your cash reserve yield significantly, I believe the extra step is worth considering. One last thing I'd like for you to remember is that the FDIC insurance, which is government insurance, provides protection of up to $250,000 per account with some exceptions. So if you have cash reserve accounts with over $250,000 in them, let's talk about your options. Well folks, that's it for this month's video. Please remember that nothing in this video is a personal recommendation. If you're curious about anything I mentioned or have a specific question, please call Ashley at the office. Let's schedule some time to talk. We're here for you. Have a wonderful day, and we'll see you back here next month. Thank you.